Hey everyone, Sean Ganner here with Simplify Accounting. I'm here to tell you this day to not set up a holding company. Okay, might make sense for you, but for a lot of cases it doesn't make sense. So first off, what is a holding company? Well, it's just a corporation like any other corporation. There is nothing special about a holding company versus another corporation. The only difference is how it's structured in your corporate structure. Many people set these up when they shouldn't. Why do they set them up? Because their friends tell them to, or they've seen content selling them on all of these advantages. Most of that content is out of the States and is not relevant to Canadians, FYI. Or it's the accountant pitching it because they'll make more money off of you if you have two companies instead of one. Or the lawyer because they'll make money off of you by setting up that corporation for you. In the past month, I've had a bunch of clients ask me about setting up a holdco. But in a lot of cases, these holdcos are just going to cost you more in accounting and legal fees than it's worth. They do make sense in specific situations, which I'll talk about. But if you're under $500,000 in gross revenue, maybe even $1 million in gross revenue, you likely don't need one. Tax legislation has changed significantly over the past several years. So where it maybe used to make sense to have a holding company, it might no longer make sense, depending on your situation. And then why should you listen to me over that other guy on YouTube? Well, maybe you shouldn't. Don't believe everything you see online. But I am a chartered professional accountant with over 10 years of experience helping out small to medium-sized business owners, ranging from those small businesses just starting out to businesses in that mid-size up to $15 million in revenue. And I've dealt with and advised a lot of different companies on a lot of different corporate structures. That being said, don't ever make a decision based on a video that you've seen online. You should really talk to a qualified CPA and a lawyer about your specific situation, but this video will give you ammunition for that conversation. So what are some reasons that people set up holding companies? Well, typically asset protection and taxes are the big reasons. But first, I'm going to talk about two situations that come up a lot. First situation is different types of income and operations. Sometimes people say, well, hey, I want another company because I have a different type of income stream or a different type of operation. Well, that's fine. You can have multiple different types of income streams and operations under one company. Just use trade names if you want. You don't need multiple companies. You may want to set up multiple companies if those operations are significantly different and you plan on selling those businesses separately from each other. The different companies will make it easier to sell those businesses separately from each other. But if it's just like, let's say that you're a realtor making 50 grand and you have a spouse that's making 100 grand doing something else, selling widgets or working in the oil field, whatever that might look like, you're not going to sell either of those businesses. You're not talking about millions of dollars. You're talking about 150 grand. Don't set up another company for the realtor business versus the oil and gas contracting business. Just have them all in the same company. It's going to save you a bunch of money. Another thing that people ask about is investments. Well, especially real estate. Like they'll be saying like, hey, look, I want to set up this company and I've got these investment properties. I want to put these investment properties from my personal name into a holding company and own all this real estate in a company. No, don't do it. That's a terrible idea. Corporations, if it's active business income, you have a pretty low corporate tax rate that you pay in corporations. But if it's passive, like rental income or investments like stocks and bonds, you pay around 50%. That's right, 50 in taxes in your corporation. You pay a ton of taxes in your corporation because the government doesn't want you using a corporation for investments. They want corporations for active businesses that are helping the economy. What happens with that 50% tax rate is that there's something called a refundable dividend tax on hand, where when you pay dividends from your company to yourself and pay the personal taxes on that income, and then you can get a refund in your company for some of the excess taxes paid, but you'll still end up paying more in taxes by having investments in your corporation versus just owning them personally. A case where it does make sense to have investments in a company is when you have some kind of operating company, some type of real business that generates active business income. Let's say a dental clinic. Let's say that your dental clinic generates $500,000 of after-tax income every single year, and the dentist is paying themselves 200 grand of that, and they're keeping 300 grand in their company. Well, that 300 grand, they can use that to invest in real estate or stocks or bonds. And the reason why they would do that, even though you have a 50% tax rate on the income from those investments, is because they just have more cash to work with up front. Because if they paid that 300 grand to themselves and paid, say, 50% tax on that, now they only have 150 grand to work with, to invest with, instead of the 300 grand. And so if you have an operating company with active business income, you have a bunch of extra cash in your company that you've paid low corporate taxes on, sure, use that company to invest in real estate or other passive assets. Go ahead, that's a great idea. But before doing that, you should really max out your TFSAs and RRSPs first. Those are some awesome tax deferral methods that you can use to save on taxes. So let's talk about the other reasons why people set up holding companies, which is asset protection and taxes. Asset protection, that's not my expertise because I'm not a lawyer, but you need to ask yourself, what are you protecting? And who are you protecting it from? Is it a bunch of real estate, cash, stocks? How much are we talking about? And what are the chances of you being sued? A holdco likely won't protect your assets from a lender like the bank, because banks require cross guarantees on everything, meaning that if you stop making payments, they will go after you personally, and they'll go after any other companies that you own that are part of that cross guarantee. So a holding company won't help you with a lender. And depending on the situation, the CRA can still go after assets in your holdco if your operating company doesn't pay its taxes. So holdco might not even protect you against the CRA. If you think that one of your customers might sue you, then you should probably have some kind of business liability insurance, regardless of whether or not you have a holding company. In which case, do you really need a holdco if you have business liability insurance? Probably not. If you're really concerned about asset protection, talk to a lawyer and they'll probably recommend a holdco, but there may be cheaper options to reduce that liability and to protect your assets. Depending on the situation, asset protection alone isn't necessarily a great reason to set up a holding company. Again, depending on that situation. Taxes. You're going to pay taxes regardless of how many corporations you have or what that corporate structure looks like. There are some tax advantages that can happen by having a holding company or a family trust, multiple corporations, and that's usually with larger corporate setups. The two tax concepts that come into play here is the small business deduction and the lifetime capital gains exemption. What the lifetime capital gains exemption is that when you go to sell the shares of a private corporation, then you can shelter up to around $1 million of the capital gain on the sale of those shares, which is awesome. And you can multiply that by however many shareholders own those shares. And so if you and your spouse both own shares 50-50 of a company and you sell that company for $2 million, you can walk away with that cash tax free. For the most part, there's something called alternative minimum tax or AMT. I'm not going to go into that. And to walk away with that cash tax free and get that lifetime capital gains exemption, those shares have to qualify. And there's a bunch of different conditions you have to meet to qualify, which I'm also not going to get into, but you don't necessarily need a holding company to qualify for the lifetime capital gains exemption. You can just have an operating company that you and your spouse own shares of, have that one company, and you can qualify for the lifetime capital gains exemption. There are situations where, let's say someone set up a company 20 years ago, it's been really successful, they're going to sell it for $2 million, but over time they've built up a bunch of cash in there, real estate, investments, etc. Well, all of those passive assets puts that company offside for the lifetime capital gains exemption. They will not qualify because of all of those passive assets. And so you can go through a restructuring with a holdco where you can strip those assets out of that operating company to purify it so that it qualifies. But if you're going to do that, you should do it a couple years in advance to selling the company. Otherwise, you might not qualify. But in a situation like that, yeah, it's going to cost some money to do that purification and to do that tax reorganization. But it's better to pay that money now than to have set up a holdco and set up a situation 20 years ago and have been paying accounting fees for 20 years on 2 companies. So you really have to look at the situation when you set these things up. Now let's talk about the small business deduction really quick. What the small business deduction is it allows you to pay a really low corporate tax rate. In Alberta, it's 11% on the first $500,000 of taxable income. This is great because it helps you grow your business. With the lower corporate tax rate, if you keep cash in your company, you'll have more cash to work with to buy assets, hire employees, etc. As soon as you exceed that $500,000 in taxable income, anything above and beyond that 500 grand, it gets taxed at the general rate, which is 23% in Alberta. It's higher. However, there's something called a general rate income pool, or GRIP, that allows the corporation to pay eligible dividends to its shareholders. Because they've paid more tax than that 11%, they get a bigger tax break on their personal tax return. It's something called integration, where ultimately, regardless of where the money is taxed, overall, the government wants you paying around the same amount of tax, whether personal or corporate, once it all flushes out to you individually. Sounds complex, right? Yeah, it is. There's lots of complex tax concepts. The Income Tax Act is way too complicated. So let's go into some structures just so that I can illustrate what this looks like. Here's a traditional holding company. You have Mr. Claus and Mrs. Claus. They each own 50% of a holding company. That holding company owns 100% of Toy Opco, which is a toy operating company where magical elves build toys and sell them for a profit. They do not give them away. The advantage of a structure like this is that if Toy Opco generates a whole bunch of income, instead of keeping that cash in the operating company, if you don't want to pay it all out to Mr. and Mrs. Claus and pay the personal taxes on it, you can shift that cash over to the holding company, Holdco, via intercompany dividends. Those dividends, because the 2 companies are connected, are tax-free. There's no taxes on them, which makes sense because the toy operating company has already paid corporate taxes on that cash. It's already been paid, so you're just shifting cash over to the Holdco. And then that Holdco can invest in real estate, investments, whatever that looks like. You have some creditor protection there because the cash is not sitting in the operating company. The issue with this structure is that if Mr. and Mrs. Claus ever want to sell their operating company, Toy Opco, in order to get the lifetime capital gains exemption, 1, all of those passive assets in the holding company will put them offside, so they will not qualify. And 2, in order to get the capital gains exemption, they have to personally sell their shares. And since they don't personally own the shares of Toy Opco, Holdco does, they have to sell the shares of Holdco. And so if they want to keep, let's say they have a commercial building in Holdco that they want to keep and they want to sell it separate from the business, they can't do that with this structure. They have to sell the shares of Holdco. And unless they get rid of those passive assets, do something with those passive assets, they're not going to qualify. It's not a great structure. Then you have this structure here, Holdco structure with a business partner, where you have Taylor Swift and Travis Kelce. They each own 100% of their own Holdcos, TK Inc. and TS Inc. And those Holdcos own 50% of Swift Enterprises Inc. This is kind of a cool structure. If you have multiple shareholders that are unrelated, it's nice to have some kind of structure like this, because what can happen here is if Swift Enterprises generates a whole bunch of income, that income then can be distributed to each of those holding companies, and then Travis or Taylor can do whatever they want with that cash in their holding companies. They can keep it in the holding companies if they don't want to pull it out and get taxed on it personally. They can invest in whatever they want to invest in. If they want to pay the personal taxes, they can pull it out. They just have flexibility. However, the issue with this structure, again, same as last time, is if they want to get the lifetime capital gains exemption, in this situation, they would have to sell the shares of their holding companies to get that lifetime capital gains exemption. If they've got a whole bunch of passive assets in their holding companies, they're not going to qualify. So you can run some issues. And then we have this sister co-structure with a business partner, which is essentially the same structure as the last one, but in this case, they personally own the shares of Swift Enterprises, and then they own 100% of the shares of their holding companies. And then what can happen in this situation is those holding companies can charge fees to Swift Enterprises, and it becomes a wash. And so that's income in their holding companies. It's an expense in Swift Enterprises. It's a wash for tax purposes, but what it does is it shifts cash over to each of their holding companies so they can invest in assets, real estate, investments, do whatever they want with those holding companies. And then when they go to sell Swift Enterprises in the future, as long as it qualifies, they can sell the shares of Swift Enterprises without selling the shares of their holding companies, and they can get the lifetime capital gains exemption. Something also cool about a structure like this is that as long as Taylor and Travis are unrelated to each other, let's say that they're not dating, there's no relation, each TS Inc. and TK Inc. can have their own $500,000 small business deduction. And with all those fees they're charging Swift Enterprises, between the two of them, now you have $1 million instead of $500,000 at that lower 11% corporate tax rate. You have to be careful. If they were related, there's association rules. There's, under the other structure, there is specified corporate income rules. There's all of these tax rules that prevent the multiplication of the small business deduction and prevent people from using any kind of loopholes. It's kind of ridiculous with the amount of rules that have come out in the past 10, 20 years. And so hopefully that gives you an idea of what holding companies can be used for. Like they can be great for multiple business partners, for holding a commercial building outside of an operating company in certain situations. Family trust can be really good in situations where you have a really large company. You're going to sell it for say $20-30 million down the road. And you want to multiply that lifetime capital gains exemption amongst all of your kids, other family members, maybe some other people. A family trust can help with that. But for the average person who has a business that they're going to sell for maybe a couple $100,000 or $1 million, $2 million, that family trust probably doesn't make sense. There are also situations where if you're buying the shares of a company, then don't buy those shares personally. Use a corporation to buy those shares. Call it whatever you want. Call it a holdco if you want, but set up a corporation, get the loan, the business loan in that corporation to buy that company. And then you amalgamate those companies, and what that results in is that business loan being in the company that you bought, so that any cash from the operations of that company can be used to repay that business loan. Otherwise, if you don't do that and you get the business loan personally, then your company is going to have to pay salaries or dividends to you personally. You're going to pay personal taxes on that to repay that loan, and you don't want that. That's a bad situation. Yeah. There's a bunch of different things that you can do, but really, like, when it boils down to it, is before doing anything, you have to ask yourself, why do I need a holdco? What's the purpose behind it? What's the intent down the road in the future? And then once you have that figured out, and after watching a video like this, then you can go talk to your accountant, your lawyer, as you're more informed, and be like, hey, look, this is the situation. This is why I think I need a holding company. Get their advice, make sure it's set up properly, and go from there. Hopefully this video was really helpful to you. I know that I talked about a lot of complex things. It's not simple. It's very complex. But what I wanted you to get out of this video was that before setting up a holdco or some kind of funky structure, like, just think about it first. You might not need it. So subscribe if you want me to keep creating cool tax content like this. Otherwise, until next time.